Good morning, good afternoon, everyone. How's it going at your end? Morning, Bob. Good morning, Sam. Hope life is going good. Great. Same here. This was one of the busiest weeks for me in recent times. So much so that I couldn't even get time to prepare the documents. I was up like 6:30 today morning to make sure I got some content to talk about today. Been very busy. In the stocks, not too much on the stock side, at least personally, but a lot of stuff going on the crypto side. Was pretty excited about it, trying to keep tab on what's happening over there, and then a little bit on the personal professional side was trying to help out a startup on their operations. So been a pretty busy week. You see a message, missed last Saturday due to picnic. Happy for Melly. Yeah, Mercado Libre. We will talk about it. So today we're gonna talk about Mercado Libre as well. That's the top holdings in my portfolio. So before we jump into regular session, I think I shared my portfolio pizza, which I generally share at the start of every month. So let me just bring that up. This is how my stock portfolio pizza looks like. I also tweeted it on Twitter. So yeah, I'm happy. Mercado Libre is the biggest position for me after, just behind cash. So Bob says the wheel of fortune. That depends on where you got into these stocks. But yeah, I'm pretty happy with how Mercado Libre has been performing. I've been in it for a few years now, and it has grown to become my biggest holding. Not that I have invested the most amount of money in this, but I kept investing in it, and it has grown at this level. That's the beauty of some of these multi-baggers is you be in it. If you have a strong conviction, if you know about their business, keep tab on it, then I don't get perturbed by, the, let's say, one particular earning disappointments, etc. So I've been holding it in fact, earlier I had sold it before I became really a patient investor. And that is why in last 2 years, I've been focusing more on investing mindset than investing, I would say, intellectual or trying to identify the great companies. Because I realized, even though in past I've identified great companies, I just didn't have a mindset to hold them through the ups and downs. But that's what I've been focusing on last few years to become a better investor. So question I see from Jay, do you hold stock on Melly or trade options too? So this wheel, what you see is purely the stock position. The stock position across my portfolio, including the one which is option account, including the one which is long stock portfolio only, including the position of the stocks in my retirement account. This is my across all portfolio positions. But to answer the question, yes, I hold stock in Mercado Libre and I trade options as well. To reduce my cost basis or to acquire the shares at a lower price point, I continue to trade options. But this wheel does not have impact of options in it. That's too difficult for me to get everything. I generally generate this close to end of a month, or maybe sometimes it takes a week whenever I can get to it. But getting to know the the value of your option holdings at that point of a time without too much of a manual work is I haven't found a way to do it. So this only involves my stock position. Oh, yeah, so we will talk about it today. So let's get started with our today's session then. All right, welcome everyone. This is our discussion number 96 for our weekly discussions on stocks, on options, on economy, on investing, anything and everything. Sometimes crypto, but we generally focus crypto for our Thursday discussion. But today I will probably spend a little bit of a time on crypto as well. So for today's session, gonna spend most of the time on doing some earnings analysis of Mercado Libre, Square, and new stock that I've added to my portfolio, Fiverr. It's been on my watch list for quite some time, but I didn't pull the plug because of the valuation. But I'll talk about it in today's session. Then want to spend a lot more time on the industry of buy now, pay later. There's a lot of stuff happening in this industry in terms of VC money flowing in terms of a lot of merger and acquisition, in terms of stocks doing good. So I want to spend some time to understand what this industry is, what are the players in this industry, what makes sense in this industry, and also we'll uncover some of the dark side of this industry. And as always, we'll spend some time on looking at the market, a little economy, some stocks, and some option trades. With this, let's get going. But before I jump into discussion, I have to state this, that anything and everything that we discuss here is only for education. This is not an investment or financial advice. So do your own due diligence on anything that we talk about. So I want to confirm before I get into everyone able to see the document. It's happened a couple of times where I've been talking and the audience say, are you sharing anything? Okay, cool. Cedric, thank you for confirming. All right, so as always, let's start either with a quote or a question. Like I said, I didn't have too much time to think about a question, so I pulled up some quote. And this really gels with me, is never depend on single income, invest to create second source. And that invest could be in any form. And this is where that pushed me into trying to create another secondary source of income. Just that my family doesn't have to depend only on me mortgaging my hours. So we make a decent salary, but that we get it from mortgaging my hours. And if I'm not around, that salary is not around. God forbid, but if I come under the bus, the income from the salary for my family stops. So at some point of a time, we have to think and make sure that we have to create a secondary source of income, possibly passive source of income. Working two jobs is good, but not great. So never depend on single source. Try to find another source of generating an income, possibly passive income, so that you can continue to get an income while you're sleeping. The income is not dependent on you clocking the time. That's very important. So sooner we learn this, took me years to focus on this one because I was very much focused on my job. For me, and that is important. I'm not discounting the importance of a job or a actively managed business. Those are important. Those build the foundation. But if we have to create wealth, we have to start building additional stories on that foundation. That's how we grow the building. And to build those additional floors, we have to either invest or engage. I would say engage in any sort, creating any sort of a passive secondary income. Some people love investments, investing in stock. I'm one of them. So I focus on stock market. Some love dealing in real estate, again, which can generate passive income, rental income. That's fine too. Not my cup of tea. Many of my friends, they are more into real estate, less into stocks. That's okay as well. It's an additional source of passive income. If you're a great writer, I am terrible. So I can't even think of writing a book. Earning royalty through books or through music is another great source of passive income. Do it once and then someone else is paying for you over time. And it gives me immense pleasure to think, okay, I've invested in some great companies. Now it's Jesse and Andy Jesse who's working for me. It is Sundar Pichai who's working for me. It is Satya Nadella who's working for me to make money for me. I don't have to work for it. So this, I really like this quote, and this is one of my guiding posts to continue to stay invested in stock market. Vijay says, get a wealthy wife. That probably could bring in a one-time, I would say, lottery ticket. But again, beyond that, anything which has been earned without putting in sweat also goes out quickly. I know, Vijay, you are kidding, but that's one source to build your foundation. Bob said another choice would be as a silent partner in a business. Exactly. Being an inactive owner of a business. That is what I do. Eventually, if we are dealing in stock, that's exactly what we do. We all are shareholders or a part owners of that business. It's a different matter that the ownership is 0.00000012%. But we are indeed an owner. So either you could find, you could be a part owner or a passive owner of a business and own 20%, 30% of it. Or in that case, you're becoming a partner, with someone who's running the business. Or you could be owning that business through having shares in your portfolio. But yes, that is important. Side business in which you don't have to actively participate. That's also another way of making an additional stream of income. There are easier ways to accumulate wealth than marrying it. And then get income stocks, right? Covered calls, 3 to 5% upside, sell puts. But yeah, the way to generate income are many. I think the first step is the most important. And it is a difficult step. That's the hurdle that we have to cross. Beyond that, once we are set up to make sure that, yeah, I want to do it, beyond that, there are multiple ways to generate it. But most of us, and that includes me as well, my family as well, have been focused on what am I going to get today. But the second quote that I want to talk about in relation to this is someone sitting in the shade today because someone planted a tree a long time ago. And I've been guilty of this, of not getting started into investment right from day one because, gosh, I need this thing today. I don't have anything to invest for tomorrow. I cannot take, let's say, Microsoft shares to grocery store. Forget grocery store. I don't think we have a problem with the grocery, but I cannot take my Amazon shares to or Microsoft shares to Microsoft Store to buy a new, Surface tablet, or Apple share to Apple Store because I want a new fancy Apple Watch or an iPad. We have to have a patience to say, okay, I'm okay to give some today's comfort so that I can plant a tree which will work out for me for years to down the line. Unfortunately, we don't think in that aspect and are content in continuously buying the fruits rather than taking some time and effort to plant the seed. But sooner we do it, better it would be. There will be initial 5-10 years where we would think, where's the money? It's a funny money. It's in the stock. My wife still tells me that you are investing, you're saying, okay, portfolio is growing. Where is it? We don't have money in the bank. Where you said we are growing, I don't see cash in the bank. So we have to come out of that mindset that I need it today, and have a little long-term mindset that we need to invest for next 15, 20, 30 years. If that means cutting down something for today, that will really work out very well. But that's a difficult mindset. Again, investing is more about mindset than about intellect. The more and more I learn about it, I think it's psychology is more important than IQ. So those are a couple of quotes wanted to talk about it before we jump into the meat of the things. Ramesh said 50 plus married to one has its own benefits, not to bother other in retirement phase. That's true. All right, quick market wrap up. Market keeps closing higher and higher. And again, while I was making lunch during the market closing hours, as I told you, I generally get off, move away from my laptop near the closing time so that I don't make any rash decisions because the market is closing and I want to take some positions or I want to do a trade, and I go ahead and do a trade even if I don't get good pricing. So I generally move away from my desk to prepare lunch just before market closing, 12:30 Pacific time, 12:45, sometimes even 12:15. And my iPad was playing CNBC, and the closing time host Sarah Eisen, and she was saying markets close all-time high. And again, my daughter, Dad, does the market every day close all-time high? Because that's what we are, she gets to hear. But that's been the reality of the recent times. Nothing different this week. S&P 500 as well as Dow Jones Index both ended at record highs. NASDAQ, not so much, but these two major indices, both were all-time high, driven by better than expected July payrolls. So we got a payroll number last week. Numbers were better than expected. Also, the jobless rate was bigger than the drop in the jobless rate was bigger than the anticipated one. So that means economy seems to be doing better. There are more people getting back to jobs. In general terms, it means it should be good for a stock market. But we are living in a completely different markets. Better economy may or may not result in better stock returns. Why? A couple of reasons. One is around the inflation. There's a little fear. There's a fear around inflation may be coming. With 10-year treasury yield jumped more than 8 basis points on Friday. So when your treasury yields go high, interest go high, that looks very well for the financial stocks. I was surprised what happened to my position on the financials ones, because those were all up 2%, 3% suddenly. And the magic of anticipation of increase in inflation and the increase in treasury yield. But could this good news of better economy, even though it is maybe accompanied by higher inflation, but the economy is getting better. More people are getting back to jobs. We have more than expected payroll numbers. We have better jobless rate than what we were anticipating. Could this be bad news for the stock market? Doesn't that sounds counterintuitive? That the economy is good, the job market is good, but that could be bad for the stock market. Why? Again, I'm not predicting anything. We were just trying to look at from a different perspective. Mostly it could be because there's a fear in the market. And in the current market, which has been pumped up, I wouldn't say pumped up, which has been helped by the position of Fed and by introducing so much liquidity. If the numbers look good, if the economy is recovering, if people are getting back to jobs, if companies' businesses are becoming better, Fed could be pulling back on some of those loose monetary policies. Could become more hawkish. We may start tapering down the buying back of bonds and mortgage-backed securities. That means the market that has been flushed with liquidity, some of that liquidity provided by Fed could start to dry down. And that's exactly what is known as those, taper tantrums, that when Fed start to taper down its purchases, Fed start to reduce its balance sheet, markets get jitters. Could market respond in a negative way if Fed start to slow down the purchases of mortgage-backed securities and the treasury bonds? That may be one reason why this good news for economy could be a short-term a bad news for stock market. It's like we are taking the stimulus out from stock market, and that may have some negative impact on the market for short term. So will we see this taper tantrum? Nobody knows. There are multiple views around it. Some analysts have to say that we have already seen that some of the sectors have retraced back from its all-time high. So market has kind of started anticipating tapering and is becoming ready to not throw tantrums, but to absorb the tapering. Now, how much of that's been already built in, who knows? So we gotta watch out for it, what happens. But I think it will be, again, we cannot continue this liquidity position and forever. It's more of a time. Fed will have to start to taper down on it. And that would be an interesting time to see what happens in the market. A macroeconomic factor which I'm watching is what happens when these additional incentives run out, when this moratorium on evictions run out. I know President had asked to extend the moratorium on evictions, but now that is being challenged in courts. So, but when these benefits or the protections provided by government runs out, what happens to the markets? So expecting some little more volatility around September when these additional stimulus, etc., runs out. Well, that's my thought on why this good news for economy could be a short-term bad news for the market. Markets have been are on sugar rush by the free money, by helicopter money from Fed. The other big thing that I've been watching is around the infrastructure bill. The reason I've been following up on the infrastructure bill, only one part, which is around how they plan to fund it, especially the impact on the crypto economy. Not sure how many have you been tracking, but when the infrastructure bill was drafted, suddenly out of a blue, we saw that $28 billion of additional funding to fund this infrastructure. We've got to find money from somewhere. And in the bill, it was proposed that $28 billion will come from additional taxes on the crypto transactions, which is great. Anyone who's making money should pay their fair share of taxes. I have no concerns on that. The concern which I had was the way it was drafted in the bill on how to collect those taxes, or how to, the methodology of finding those taxes. Right? So quickly, I think the crypto, even though many of these big protocols don't have a CEO, but they do have great lawyers, and there's a lot of frantic lobbying. Or last weekend, I think this new line in the infrastructure bill was introduced, or previous Saturday. There was a lobbying over Saturdays and Sundays and Mondays, and then an amendment was added. Then another amendment was added. And I think today those amendments are being debated. So the senators are working today. It's a working day for them, not a weekend. But there's a lot of these amendments on infrastructure bill are being debated. So this is 2,700 pages. Our bill is 2,700 pages. And this meeting is still happening today to continue discussions on various amendments. But they'll try to make sure that they can, get this through ASAP. 22 amendments have already been debated on this particular infrastructure bill. But I think there are two big amendments. One is for Defense Department improvements. The other bill is for provision on cryptocurrency taxes, which is kind of holding this up. Now, these are the two hot ones. For me, I'm more interested in to see where the wind blows, in which direction the wind blows on the cryptocurrency provisions. The first, the draft in the bill, the way it was drafted would have made anyone and almost everyone dealing in cryptocurrency as a broker. And then there would have been a requirements like every stockbroker has to know your customer, to generate 1099 or keep track of all the transactions of the customer and provide those transactions to IRS. Right? So I mean 100% that all brokers should do it. But the way this bill was drafted would have made me a broker, would have made any miner a broker, would have made any validator a broker. So if I'm running a node, any crypto node to validate a transaction, I would have become a broker. And the way this ecosystem works, there is no way I have information for any of those customers. So if I were to operate, I am in a violation of the law if it is implemented and becomes the law the way it was initially drafted. I would have been in violation from day one. Many software developers who are working on this would come under a purview as a broker on day one. So that would have been a detrimental to the overall crypto economy, and we could have seen a lot of people either have to move out of US, otherwise you stay in violation for the law. Oh, that is why there was so much of hue and cry and pushback from mostly crypto industry, saying it's okay, we don't want not to pay the taxes, but the way you're calling everyone as a broker is simply impossible to implement this, and everyone will become, I would say, will be in a violation of law. So there were amendments that were pushed out. Then on Thursday, another amendment was pushed out, which I was pretty angry on that amendment, because that was kind of a government is deciding which protocol is better. And I'm sorry, I'm getting a little deeper into this one because this does concern, and this is holding up the infrastructure bill as well. It's a big concern to me personally, where government comes in and decide, okay, we will let iOS live and not Android. In this provision for cryptocurrency, one of the amendment which White House administration is favoring is, which says, okay, we will exclude all these miners and validators and software developers. We will exclude them from a list of brokers only in the projects which use proof of work as a consensus mechanism. Why is White House administration deciding which technical mechanism, consensus mechanism, should be used? It is like picking Mac over Windows or other way around. It is picking iOS over Android. That's not fair that government gets to decide which protocol should win. The protocols should allow to coexist, compete in the market, and maybe the best one wins. But that's not how it's working. So it's a pity. The moment you start to read into the details of amendment, it's a pity that our lawmakers and the folks working with them have no idea of how this whole economy actually works. The miners who run the proof of work are not the ones which are actually validating the transactions. And the bill says only those which are validating the transactions through proof of work will be exempt. That's not at all how this industry works. So it is appalling to see that the folks who are drafting the bill have no idea around this industry, the very basics of the terms, the knowledge of even the terms. What is a validator? What's a miner? Who does what? But they get to create laws. So we'll see. And I saw a lot of uproar, especially from a CEO of Coinbase, Brian Armstrong. So maybe we'll spend a couple of moments in reading through this. He came out really, really strongly against what he saw. There are few key moments that define our future. One is happening now in the Senate with respect to infrastructure bill. At the 11th hour, this is the second amendment around this, which I was talking about. Senator Mark Warner has proposed an amendment that would decide which foundational technologies are okay and which are not in crypto. He had asked for proof of stake validators to comply with the impossible but not proof of work miners. Why? It's not clear. But we could find ourselves with Senate deciding which types of crypto will survive government regulations. Here, the government is trying to pick winners and losers in a nascent industry today. Imagine if the government decides iOS is okay and Android is not. And that software developers building iOS can thrive, but Android is outlawed. If you're really interested in it, just Google on this one, look at a Brian Armstrong. But that's what really is happening. It is pathetic, but it is what it is. Hopefully, the Senate will not pick up this 11th Hour Amendment and pick up the previous one, which is not still not perfect because it still doesn't explicitly exclude various these parties, but at least better than the government trying to pick who will win and who will lose. Sorry, that's my rant on the crap that I've been seeing around on the discussions on this crypto phase. And this $28 billion worth of income or worth taxes. By the way, there is no math. We haven't seen, I mean, the proposers of this, the bill, the joint senator, I think this is a bipartisan bill. We haven't seen a math of how they arrived that we'll get $28 billion from crypto taxes. It's great if we can, but there's been no math that have been shared. But now that is one amendment that's holding up this whole big infrastructure bill, a $1 trillion worth of bill. We'll see what happens today, but a lot of flurry of activities in crypto world because of this over whole of this week. Sorry if it was a little diversion, but it is important to understand on this new economy or a new sector that's becoming bigger and bigger. All right, coming back to our markets. Financials, no doubt, were the best performing sector for this week. So up more than 3.5%. Again, mostly driven by the hope or the concern, depending on which side you are. If I'm I'm an investor in a bank or in the financial sector, I hope that the inflation goes high, then the interest rate will go high, will work well for the financial sector. But if I'm not, rise in inflation is not good for consumers. Things become expensive. They already are very expensive. But we did see financials were the best performing sector. Almost all sectors ended in green. Materials and industrials were doing much better until Thursday. On a Friday, we saw some weakness in materials and industrial, but eventually for the week, they still managed to close in green. So pretty good week from a stock market perspective. Still, how long will this continue? New all-time highs? Who knows? Again, that depends on which analyst you're listening to or which reports you look at. There are completely two different outlook or predictions on what may happen in the remaining 5 months of the market. All right, any other questions on till now? I think there was one question earlier which I skipped. Okay. What's up with Ethereum? Okay, so that's getting into our crypto stuff. I can talk about it unless there is some other question. So if you look at, maybe let's cover that question. We'll come back to this. On Ethereum, let's go back and look at the crypto economy. All right. So going back, looking at in terms of the crypto, the top 10, and the question is on Ethereum, which is now again more, it has crossed the $3,000 mark after a long time. After going through this so-called crypto winter during the summer, now it is back up and beyond 3,000. The reason is there was a big improvement in Ethereum that went live on August 5th. It was a fun. I got up at 5 a.m. to watch the live upgrade. It was fun to see most of those core developers, Vitalik Buterin, rather, I forgot the name of that architect. So these are all on, and it was being live streamed on YouTube. So it was fun to watch them. Seeing this new upgrade, which is called London upgrade, go live on August 5th. So with this introduction of the change, I'm not going to get into the details of what had, the details of the London upgrade and what changes in the Ethereum protocol has gone through. But the most important one is it is now started to burn Ethereum. There's been changes on how the Ethereum fee will be treated and all that. So Ethereum could become what they call as a deflationary asset. So till now, the whole, I would say, the USP of the reason behind investment in, let's say, Bitcoin is it's a sound money. You cannot inflate Bitcoin. It's got a limited supply, fixed supply. Right? It could be a replacement for your gold. It's a digital gold. Whereas Ethereum, it's an oil. It is used to run your DeFi's and all your decentralized economy, but it's got a consistent supply that's being added into the Ethereum ecosystem. With the recent change that has gone in, the Ethereum, based on the transactions, there are Ethereum that are being taken out of supply. So the circulating number of Ethereum eventually could actually start to go down. Right? Not yet, but only after Ethereum 2.0 is implemented. But since August 5th, till now, 10,000 Ethereum, they've already been burnt. Burnt means they've been taken out of supply. So now if you have a base, now this is a basic supply demand mechanism. It's not that the overall supply has come down, but so many Ethereum have been taken out of a circulating supply. So the number of Ethereum that are being added into the ecosystem has slowed. Now, once the ETH 2.0 come in, it will again slow, even might become deflationary. And that is what is driving some of the money coming back into Ethereum. Is now it could serve dual purpose. One, it could serve the purpose of oil, driving and greasing the whole decentralized economy. Number two, it could serve as a purpose of a deflationary asset. That's why Ethereum has gone way higher than Bitcoin. For the, I think, first time we are seeing that this whole crypto market was driven more by Ethereum than by Bitcoin. Otherwise, generally, it's the Bitcoin is a big daddy. Bitcoin rises, it will lift all other cryptos. But this week, it's the Ethereum that did the job of the whole big rise in the crypto economy. I hope that answers the question. Well, this was another big update, a huge update, I would say, which has been I've been tracking on this for a few months, which was eventually implemented on August 5th. That's why drove the prices of Ethereum high. All right. Okay, let's jump into earnings. No other questions? Cool. So let's talk about Fiverr. I don't think I've ever spoken about Fiverr in any of the previous sessions because I was not interested in it, haven't invested in it, but now I am interested in this one. Anyone over here owns Fiverr in your portfolio? Okay, I see one. Asif owns some. Okay, Zifted also owns. So maybe you probably know about Fiverr more than I would. But for those who are just getting started into this, Fiverr is a company that, how do I put it, that facilitate the other businesses to own or to basically hire temporary workers. But the most of them are, this is a market, let me put it this way, this is a marketplace for gig workers. There are a couple of platforms that are already exist. Two biggest ones are Fiverr and Upwork. So I use Upwork for getting some of the work done on the website and all that stuff. So the way these marketplaces operate are, if you are a business who wants to hire some talent, you go to Upwork or you go to Fiverr and register yourself as a business. Then you can create a project saying, you know what, this is the work that I have, and you have other people bidding for your work, and then you select and award the work or award the contract to whoever developer or the other company you want to award the contract to. And then the money is taken out, moved into an escrow account. And once those, you basically define your milestones on what milestone will you pay the developer. As and when those milestones are reached, the money is released from escrow to the developer team. And for facilitating this marketplace, the platforms like Fiverr, platforms like Upwork, they take a slice of the transaction fee. So that's basically a business model, is trying to connect gig workers to the businesses who are looking to find some gig workers to do a temporary work. So if I got a work which is only for next, say, 2 months, say I want to make some changes to my website, and I don't want to hire a full-time software developer in my company. I want someone on a contract to come and work for me for 2 months, and that's it. It's like, so I can kind of outsource this to any freelance developer. Or let's say I'm running an event and I want someone to create a nice posters, marketing material for that event. I can go to these platforms and specify my need, or I can go to them and find out the talent who have already specified that, a predefined gigs, and I can pick up, okay, I want you to perform this gig. So there are multiple type of models that exist, but essentially this is what this whole Fiverr and Upwork is about. It is to enable the gig economy for different type of talents. So let's say if you go to fiverr.com. So find the perfect freelance services for your business, right? Website design, logo design, drop shipping, voiceover. You want to create your social media presence, just the data entry. Someone can create a book cover for you. Someone can optimize your website. So all these type of temporary work, you can find the expertise on Fiverr or on Upwork. So that's at a high level is their business model. Their mission is to change how the world works together. And in 2020, when the physical economy was almost at a standstill, the factories were closed, the retail stores were closed, the businesses had to quickly jump online to sell the wares. And all these platforms had a tremendous growth in 2020. I mean, just like any other, I would say, the whole digital transformation, as Satya Nadella used to say, The 4 years worth of digital transformation had happened in 1 year. So every company that is involved in enabling businesses to go digital enjoyed a huge tailwind last year. Fiverr, Upwork, not an exception. They enjoyed the similar tailwind. So why Fiverr is focused on this particular aspect? Because the world is changing and the way people work is also changing. So traditional workplace, long-term employment. The future is freelancing. More and more people are turning towards gig work. Work from office to work from anywhere. From local teams to global and remote teams. Work full-time, receive monthly salary to get paid for action and results. Study young, standard profession, continue study, gain unique expertise. This I completely agree to. We have to continue to study and upgrade ourselves if we want to be to stay relevant in economy. So for this quarter, Fiverr revenue grew 60%, which was higher than the management guidance and higher than the Wall Street expectations, which is good. So if you look at it, 60% year over year, to $75 million was their revenue in this year. In 2019, it was $26 million, which is 3x in 2 years. Not only they grew their revenue, but they also grew the expenses grew at a lesser rate. So they had a better operating leverage. So they had an improvement in their operating leverage, which shows up in their EBITDA margin. So non-GAAP net income also doubled. So higher revenue, 60%, and the better operating, I would say better operating expenses, resulting in a better operating leverage. Net resulted, we got a non-GAAP net income doubled. They also doubled their active buyer base. So buyers are the businesses who wants to buy services of freelancers or of gig workers. So they have doubled their active buyer base from last year. And as we've seen, they tripled the revenue in 2 years. The take rate grew 80 basis points. So take rate is important for any marketplace type of a company. So when I look at DoorDash, I want to look at what the take rate is. What is DoorDash? It's a marketplace. They basically connect the food providers to one who are hungry, people like us. So irrespective of the revenue could increase if the restaurant just increases their prices. The overall, not the revenue, but the gross value of the that is being transacted on the marketplace will increase. But will the revenue increase? For revenue to increase, you also need to increase your take rate. Either increase the overall value or increase your take rate. So good thing is that the Fiverr take rate actually increased by another 80 basis points. Now it is 27.8%. If you go back and look at, I don't know, was it DoorDash or Instacart? I think we analyzed DoorDash. Their take rates are pathetic. I mean, but that's why the food delivery is so competitive, because the take rates are very low. So I'm happy to see their take rates increasing. The other thing which Fiverr launched was a Fiverr Business. Again, this was launched just 3 quarters ago, right? And now it is already the 5% of their marketplace revenue. So I do see this as additional tailwind behind Fiverr Business. So what is this Fiverr Business? So like I had mentioned earlier, on a Fiverr, if I'm a business, I can go and hire developers, track all the milestones, and manage the project myself. All I'm getting from Fiverr is a talent pool, right? But Fiverr Business is like a concierge service. I don't want to take that headache. I want someone else to take that headache for me. So that is a white glove CSM service. It's a curated supply. They already have vetted those software developers. So when I had last year, when I was working on updates to my website, I'd interviewed at least 10 developers to pick one, right? Talked about what they worked upon, what kind of other stuff they have done, do they understand the space and whatnot, and eventually how much they're going to charge. But if as a company, if I subscribe to Fiverr Business offering, Fiverr will do all the stuff for me. And what they've also seen is the buyers have significantly increased their spend after joining Fiverr Business. So means they're actually seeing a value in getting that white glove service from Fiverr. Another metric is high value buyers is 61% of total marketplace revenue, which is good. High value buyers, they cost you less in terms of maintaining and operations, but brings in more revenue. Right? I would rather have 5,000 buyers, each spending $2,000, than having 50,000 buyers, each spending $200. Because 50,000 buyers means more cost of operation, but the revenue in both cases is still the same. And those high value buyers are also stickier than the low value buyers. So it's good to see that their overall revenue, most of the revenue is generated from high value buyers. Means the amount of the value of the project that is being worked upon is getting bigger and bigger. And it grew 50% year over year. And they also had a partnership with Salesforce, Wix.com. That means the customers of Salesforce and Wix.com, if I am using Wix.com to build and host my website, and then I want to get some additional changes, from the Wix. They basically have a collaboration in which I may be able to directly get the services of Fiverr, from my Wix.com. So all those customers will have a better integration with services of Fiverr, which means they could see some additional customers coming from these channels as well. But the stock is down 25%. There was a question on, Anil says, why Fiverr dropped 30% after earning results? So I think it was down 25% after earnings, probably went further down. Why? The company lowered 21 revenue guidance from 59 to 63% to 48 to 52%. So company is saying earlier last quarter they'd given a guidance that we will grow in 2021, will grow between 59 to 63%. Now this quarter they told, you know what, we probably will grow only between 48 to 52%. So if I take a midpoint, now they're saying from 60% growth, we'll grow only 50%. Does that means, is it fair to see this stock being punished by 30%? I think it is an overreaction. So, but if we just ignore what they told in the last quarter, nothing else have changed. So in the last quarter one, so prior to quarter one, prior to when they had told that they'll grow by 60 million, Fiverr had given an indication in, I would say, the fourth quarter of 2020. In the fourth quarter of 2020, they gave a forecast that in 21, they will bring in $277 to $284 million. So that was their forecast for, let me go back. Let's look at Fiverr. And let's look at its chart. Oops, 1 second. So previous quarter. Yeah, so before this quarter, their guidance was that they will bring in the revenue 277 to 284, say $280 million in 21. Last quarter, when they gave the results, they increased it to from $280 million to $305 million, which was jump off from 280 to 305, which is $25 million higher. And now, in the recent quarter, they tapered it down back from 320 to 285. So in net, they are kind of coming little above than the forecast that they gave in the Q4 of 2020. Nothing much has changed. Only difference was because they've reduced the guidance and the market kind of punished it, saying, oh, everything's going bad about the business or whatever. So, but if we dig deeper into the numbers, I don't see anything which is a huge concern. But the fact is, even that despite these tough comps, because we had a COVID last year, everything was growing gangbusters. Even if you have to compare the Fiverr performance against the previous year, management is still expecting to grow by almost 50%. These are the very tough comps to meet. It's a good gross margin business, 83% gross margin. So again, I think this was an overreaction. And because the stock got punished down by almost 30%, for me, it was a good time to, think about and say, hey, maybe this is now looking at a valuation where I can start to get a little bullish on this one. Again, it's a education opinion only. It is still expensive stock, but from being super expensive, it is now less expensive. And there is not much change in the business. It's just a question of one quarter. If we just ignore what the guidance that they gave in a previous quarter, nothing else has changed. So if the stock was here from before the previous quarter guidance, like 200 plus, 160 may be a I would say blessing if you want to open position in this one. Again, I was never into Fiverr, haven't looked at it, but this sudden reaction, I thought maybe let me just now look at it in terms of, is there any issue in the business as such? Growing 50% against how fast they grew in COVID, I think that is still impressive from a business point of view. Now, stock could do whatever it wants to do. It could go down 50%, 60%. In my opinion, I think that's an opportunity for those who were not in Fiverr, maybe to now start look at Fiverr at a cheaper valuation. So I am long on Fiverr now. So that's about Fiverr earnings. Let me look at some questions. Why Fiverr dropped 30%? Anil, I already answered that. If you still have questions, to let me know. Zifty says lowering forecast due to people returning to office. Yeah. Another question, how did you interview them? Zoom or chat? I used Zoom to talk to developers. I have not used Fiverr. I've used Upwork. So I'm assuming Fiverr also has a own features. All of these platforms also have a feature to communicate with the gig providers. So even Upwork also has, I can call them up or start a video conference, or there's a chat feature in the Upwork also. Sometimes I use the inbuilt chat feature, sometimes I use Zoom. On a insider and institution own 70% of Fiverr, just checked on fingers. Oh, I didn't even know that, which is again makes me even more bullish on Fiverr if such a big percentage is still owned by institutions and insiders. Overall, so I always found it to be super expensive at these valuations. So it was on my watch list, but never really got to dig deeper into it and look into it until what happened in the markets after this recent quarterly earnings. How does it compare to Upwork as an assignment? Or as an investment? The market shows itself. So as an investment, Fiverr has way outperformed Upwork. And I would say the proof is in the pudding. But could we own both? Sure. I've started my first investment on Fiverr as a in the gig economy. I haven't looked at Upwork, but I'll probably study Upwork and see if I want to initiate position in that one or not. But from a stock market returns perspective, Fiverr has way outperformed Upwork. The bar to getting into Fiverr business is low. There is no kind of a right in terms of that they don't have any intellectual moat in this business. But this business is very sticky business. Once a business or signs up with either Fiverr or Upwork, you generally don't move around and try to jump between these businesses. So I assume there's a lot of this spending which Fiverr is doing, a lot of new businesses that they are creating, is to grab the more and more of market shares as soon as they can. And once they have that, then those businesses which continue to, because this is a little sticky business and which shows up in terms of their repeat business and increased spending. Once you have more the initial market shares, you would be able to monetize those as you go along. So that's my opinion. Again, more, this is also have a network effect. As a business, I would like to go there where I have a more choice, where we have a more workers. And workers like to go to the platform where there are more businesses available. So the sooner you can grow your network, better it is. The web designers will jump to a cheaper middleman as soon as they find one. Yes, the gig workers will jump around. So over long term, will the margins come down? Sure. Eventually, any marketplace, the margins will slowly come down as more and more competition comes in. But workers or the web designers or gig workers will still like to stay on the platform where they can find more work. But when the margins get, and for sure, I think even now Fiverr would have been facing competition from Upwork because they are both competing for the kind of a similar pie, but they are still able to increase their EBITDA margins. They're able to keep their costs down. So higher the volume, better thing they'll be able to, to manage it well. One thing I noticed, the non-US companies like Fiverr don't get hype endorsed as much as US ones. Founders are in Tel Aviv. And my personal experience, again, this is not, I wouldn't say industry standard, so don't take it as that. But my personal experience is many of these companies founded in Israel are actually turn out to be, seems to be a good businesses. So yeah, I didn't know about a Fiverr's background, but they don't get so much, like Zifty said, they don't get so much hype, but they perform really well from a business point of view. All right, so that's about Fiverr. Next is one of my favorite ticker is Mercado Libre. Okay, so let's look into the Mercado Libre. Okay, anyone who owns Mercado Libre? Yay, nay. Cedric says, I used to. Okay, now living with the, no, I mean, we shouldn't have heartburn. Asif gives +1. Zifty says it's expensive. No, it is not. If I really look at Mercado Libre, it is still not expensive. It's cheaper than Fiverr. It's only 19.5 price to sales. We're not paying through our nose for this. This used to be a definition of the expensive stocks. Look at this, 116. This I would call expensive. I haven't opened any positions in Snowflake yet. This is expensive. Excuse me. Let's look at few. How about Airbnb? A little expensive than Mercado Libre, not too much. Any other high flying stocks? Okay, Hood. I want to talk about Hood later on. No sensible analysis can be done on Hood now. So maybe pick another company. Growth companies. But this is not expensive now. Has come down. So Mercado Libre, I don't see this as an expensive stock. 19 times sales is what we are paying for Mercado Libre. Not expensive. Per share, it is $1,800. But when I look at whether the company is expensive or not, per share is immaterial. Amazon's per share is $3,300. It is way cheaper than some of the other stocks. Looking at per share is immaterial. That shouldn't. So Zifty, I don't know from what was their context when you said it's expensive. I don't see this as an expensive. With respect to what the business can do, I don't mean valuation, meaning hard to buy shares or options. So lesson number one for me as an investor was forget about what the per share value is. When I look at a company to find whether it's expensive or not, look at the overall valuation, because now if I can't buy 1,800, I can buy half of a share, 1/4 of a share, 1/10 of a share. I don't have to buy full shares. So that's a great thing about the fractional shares investing is I don't have to worry about whether it is 1,800 or whether it is 3,000 or whether it is 10,000 shares. If I have only $500 to invest, I can still invest and buy those shares. I'll just buy a fraction of it. So prior to this fractional investment, yeah, it made sense to look at the individual share prices. But now with fractional share investment, kind of most of the brokers support. I know TD Ameritrade probably doesn't. E-Trade, I don't know. But Fidelity does support fractional share buying. Robinhood supports fractional share buying. So if you just want to get an exposure to this, and you can only invest $200 per month, you can still take an exposure to Mercado Libre. So let's look at what the business is, how the business did. So overall, Q2, their revenue grew to $7 billion, which is 46% gross merchandise volume. Oh, sorry, not the revenue. This is the gross merchandise volume. Right? The number of items sold on this platform grew 244 million, 37% year-on-year growth. Again, we are comparing this quarter with the quarter of last year. Quarter of the last year, every e-commerce, every online businesses had a huge tailwind from COVID. And now they have been able to grow their net revenue 102% as compared to what they have done in COVID-infested, COVID-impacted quarter last year. I think this is great. In US, the shares of Amazon went down because, your comps of last year, when you compare it with what they've done during the COVID and what they've done now, wasn't that impressive. Or, they expect a little slowness. So growing against those higher comps and growing more than 100% is great from a Mercado, from a business point of view. Okay. So the top shows their marketplace wherein you buy and sell goods. But Mercado is not only like Amazon. So when someone asks me what's Mercado is, I would say it's Amazon, eBay, and a PayPal all combined together in one company. So the below section is around their payment section. So this is the total payment volume or value. It has grown 72%. The total number of payment transactions, the number of payments, the transfers that have happened on their system grew 80% year over year. And not if, even if you just look at the previous quarter of 2021, Q1 of 2021, between Q1 to Q2, they added an additional 100 million transactions. It is amazing. So Steve says, is it a US company? No, it is not. It's a Latin America based company. But PayPal has a stake in Mercado Libre. So most of its operations are in Brazil, Argentina, in Latin America. So let's look at the other businesses that it has. So it has got a marketplace, just like Amazon has got a marketplace. It also has its logistics business called Mercado Envios. So if we look at the logistics business, again, won't spend too much time, quickly look at higher level numbers. It grew 83% year over year. 83%. And 77% of all volume was delivered in less than 48 hours. 2-day delivery, 77% of the volume was 2 days delivery. And this we are talking about in the countries wherein the infrastructure, the delivery infrastructure is not as great as in US. So despite all those challenges, they are still able to deliver 77% of volume in 48 hours. They could do same day delivery in 20% of the zip codes. And over half of the purchases were delivered the same day or the next day. So again, I still don't see any issues in this. I'm pretty happy with the numbers that they have posted. Let's talk about the other big business, which is now growing bigger, is the payments space. In terms of their Mercado Pago. Again, the consolidated total payment volume on means the payments done on Mercado Marketplace. But the beauty of Mercado Libre is, like, unlike Amazon, you can use Amazon Pay to pay on Amazon website, but you cannot use Amazon Pay to pay to your retailers. You go to Costco, or you go to Smart and Final, you go to Safeway, you cannot pay through Amazon Pay. But Mercado Pago, you can pay on the Mercado's marketplace or any of the other retailers. So that is called payment. TPV on is what the payment done on their own marketplace. TPV off means off their marketplace, outside of their marketplace. So they have grown 96%, ignoring the foreign exchange fluctuations. But if you include on the US dollar basis, it's 47% growth as compared to previous quarter. Total payment volume surpassed $17.5 billion, growing 72% on FX neutral basis, discounting the impact of the foreign exchange. Off platform payments is 59% of total volume. Means they are not dependent only on Mercado Libre's own e-commerce platform, own marketplace to grow this business. Already off platform has grown to become a 60% of total. So this, I see a question, payment outside, so sort of like PayPal? Yes. So I can go to website and pay through PayPal. Similarly, on the Mercado side, I can in Latin America website, or even on a physical retailer space, I can go there and pay through Mercado Pago. That is why I said this is a kind of a combination of businesses of Amazon, where it competes in the marketplace. By the way, Amazon is also in Latin America, but they haven't been able to compete with Mercado Libre. And it has got a payments, which is much like PayPal. And now they have actually I think in the previous quarter, when I reviewed, they were moving into additional spaces, which is investment management, asset management. And now 19 million investment accounts. This is again, pretty new business, asset management. But they already got 19 million users who are using their asset management product in order to earn some, yield. So what eventually they want to do is, I actually heard, I was listening into the shareholder call, or the earnings call in this, is they eventually want to get into a debit card, credit card, increase the loan portfolio. We want Mercado Wallet to become a super app providing payment, investment, insurance, loan, credit, everything. So right now, they are big in only this one. They started in this, got 19 million accounts, a lot more runway to grow. Way more runway. And they also added buy now, pay later feature within the wallet, within their app. So again, huge runway in front of them. And I like that the management is also thinking about, all these additional sources of growing the business. This is where their credit stuff comes in, taking loans or giving credit to buyers. That has grown handsomely. Again, 29.6% year over year overall credit portfolio. Okay, I think that's all on Mercado Libre. It's not that they don't have competition. Like I said, Amazon is already in Latin America. They've been beating Amazon for a few years. C Limited is also now competing in Latin America. So C Limited is again marketplace plus payments plus gaming revenue, mostly focused in East Asia market. But now they are competing on the Latin America side also. But Mercado Libre has been able to grow all these and post all these numbers despite all this additional capital, which is good. How about crypto participation? I didn't see it on the slide deck, so maybe it's not as big right now. I don't know if they've started accepting Bitcoin as a payment. Maybe Mercado Libre wants a Bitcoin payment. Let me just search for it. Oh, okay. So they had 7.8 million worth of Bitcoin on their balance sheet, looks like. So they bought 7.8 million, not a huge one, but given what has happened in last, this week, probably this would have increased in value. But it does say that they have embraced Bitcoin Pay. But I don't know how many customers are actually paying through Bitcoin. But to me, looks like if this wasn't highlighted in their earnings deck, probably not that big a deal for now. How is Melly par with SE then? So I haven't looked at SE, C Limited, but I guess both of them are doing a similar amount of work, just that they understand the geographical regions are different. SE is the leader in East Asian market. So you want to have exposure over there, SE may be your better bet. Mercado Libre is in the Latin American market. They have a stronghold in Latin American market. Amazon, PayPal have a stranglehold on North American market. So depending on how you want to, which areas you want to focus on, you could look at different companies. There is no harm in owning both of them, SE and Melly. Maybe split your investment into multiple of both SE and Melly. No harm in that. So that's around Mercado Libre. Next, we'll talk about Square. Okay, any other question? Okay, Vijay says Melly may allow Bitcoin to buy goods. Looks like they already had allowed. Is there a way to find out their market size? I haven't looked for it, but I know that they are the dominant player in the Latin America. But what's their overall share? I guess there will be. We'll just have to Google it to find out if there is any report around overall market share. But if you really look at this, Mercado Libre, this is what? $90 billion company. Just 90. Could it grow to become $500 billion in next 5 years, 10 years? I think if the management continues to execute on their plans that they have shared, on their growth ideas, I have no doubt that they will be able to reach $500 billion in valuation in 5-10 years. So I still continue to stay bullish on Mercado Libre. It has grown to become, like I was saying at the start of the session, while we were just warming up, it has actually grown to become the biggest holding in my portfolio. And I have no intention of selling anything right now. Let's talk about Square. So Square has got two type of businesses. One is their cash app, which is more consumer oriented, and the another one is a seller's app, which is more business or the sell side. So cash app, in June, cash app had reached 40 million monthly transacting active customers. 40 million active customers on their cash app. We believe customers have found increased utility across our ecosystem, as nearly 2/3 of our monthly actives transacted each week. So pretty active user base they have. Overall volume is now 4x compared to 2 years ago. Brokerage product has seen significant adoption. Now they got 4.5 million customers. Robinhood has got 22 million customers. So this is a newer, they started allowing the customers to buy and sell stocks very recently, but they're seeing already 4.5 million customers, which is increase of 3 times more than a year ago. Increasing the deposits into the ecosystem. Inflows per monthly transacting from a transacting active customer nearly doubled as compared to 2 years ago, which is great. They're getting more and more money into the Cash App ecosystem. Some of the products that they have under the Cash App, Square Savings. It simplifies budgeting for sellers by allowing them to automatically set aside funds from daily sales into savings account. So if I'm done a sale, I can move that into my savings account. Square checking account, which means as a business owner, I can have now access to the checking account. It was surprising for me when I look at some of the numbers and which studies which shows that most of these, many of these, I don't know if most, but many of these small businesses who are on a Square, they basically don't have a separate business checking account. They use their own personal checking account to move money in and out. And if you're a small business owner, if you're using your own personal checking account, then it's difficult to keep track and separate the liabilities as your personal liability and the business liability. So now Square is actually making use of their banking license. Square got banking license a few years ago, or two years ago, I guess, but they never made use of it. But now they're making use of that banking license to provide checking, savings account, loan portfolio, and all that. So that's where now they have a Square Savings, Square Checking, Square Loans. Total revenue grew 4.69 billion, up 143% for this quarter. But we should ignore this because this includes a lot of Bitcoin revenue, which I don't know why they add it as a revenue, because they should only be adding the percentage that they earn from the transaction fee as the revenue. But that is why I think Square is kind of doing the okay thing, but by not focusing on net revenue. So when I was looking into Square and looking into their shareholder letter, first thing I wanted to find out was, let me just bring that up, is what's the total revenue? And they had not highlighted, like, as I would see revenue being highlighted on other companies. So if you look at it, their highlights doesn't show revenue. I'm like, what happened? Isn't that the first thing I should focus on, is how you grown your revenue? They talk about gross profit, adjusted EBITDA, cash up gross profit, seller gross profit. I'm like, where's the revenue number? Where's the revenue number? I had to go down all the way to this page where it's mentioned in a sentence that total revenue was this. I'm like, wouldn't you like to talk about and boast about the fact that your total revenue grew 143%? But then I realized why they are not emphasizing on revenue. So coming back to this, it is because if you exclude Bitcoin, the net revenue is 101.96 billion only, which is still up 87%. But I think if they start talking about these numbers, 4.69 billion as a revenue, it doesn't give the exact picture. So, but 87% year-over-year growth, I would say that is still amazing growth. So even if we exclude Bitcoin, anything related to Bitcoin, net income grew by $204 million. A $77 million came from sale of investment in DoorDash shares. So I had no idea that they actually hold the DoorDash shares. They sold those. So $77 million came from that. $45 million they had to take impairment charges. Like all companies had to take who have a Bitcoin on their balance sheet, because in this quarter, Bitcoin has gone down in the second quarter. So they had to take the impairment charges. But they have enough cash on their balance sheet. They got $7.1 billion on their balance sheet. So overall, I am pretty bullish on Square and continue to stay bullish on Square. Now if you look at the gross profit grew 91% year over year. So compared with 2 years, it grew 57%. Then there's a breakup of how the cash app gross profit and the seller's gross profit. Still very healthy on both sides. So looking at the business, I don't see any kinks in the business just yet. So again, Square, PayPal, these are the, I would say, the new financial services company. Not too big yet. PayPal has grown to become $300 billion. Square is still very small. And if they continue to deliver what they are projecting their growth, I think I'm still bullish on it. Okay, never understood how banks in general make money by free checking and savings account. They give out the money in terms of loan. So they get the deposits in, and they can lend out those deposits in terms of loans to make that money. Square is one of Cathie Wood stocks, the reason to avoid. Well, that depends on what kind of investor you are. Cathie Wood has got a lot of stocks. Some are very, really, really long-term bets. Many of the biotech, genomic stocks, space-related stocks. Some stocks are growth stocks, but not as speculative as some of the other ones. So you got to make your own choices. I don't look at whether Cathie Wood owns these stocks or not when I'm trying to make a decision, especially on the Square. How does Square get revenue from Bitcoin? investment, not a payment yet, right? Yeah, so Zift is on a Square Cash app, you can actually buy Bitcoins and sell Bitcoins. So Square gets like Robinhood gets, which is a transaction rebates. So when you buy or sell Bitcoin or any other crypto on Square, Square get paid for every transaction. So that's the revenue from, no, so not the revenue. So that's the actual revenue will which come from a Bitcoin. But what they mention as a revenue is, I think, the value of the Bitcoin being traded. That is why they're not highlighting that. Square hit new all-time high, so resistance, right? Can buy cheaper. That's always a difficult decision to make. I have seen many stocks gone from one all-time high to another all-time high. So what I do is I don't invest 100% of what I want to put in a company at any one price point. So if I want to take a position, maybe I'll put in only 30% of, let's say if I want to invest $100 in Square, maybe I'll invest only $30 now. And then wait for later. If it comes down, fine, I'll add another 30%. Because we don't know where it will come down. Will it come down to 260? Shall we wait for it to come down to 240? When it comes to 240, shall we wait for it to come down to 220? We don't know. So that's a difficult decision to make in terms of if it is an all-time high, has it hit resistance? It could still go make another all-time high. So if you want to take a position, take a smaller percent. Don't invest 100% at the current price point. Maybe invest 25%, 30%, whatever you feel comfortable with. Yeah, if you're on options, you can sell a put. So you also have a little room for error if a stock falls down. If it doesn't, then you make your money. So generally, when I initiate a first position, I'll start with selling puts and get it at lower than the market price, so that now it's all-time high, could fall down, it's okay. I'll still be fine. If it's not, okay, I made some money anyway. So that's my preferred way to get into position. But if I'm not using options, then if I'm $100, I'll probably put $30 now and wait and put $30 later and wait and put $30 later. And believe me, we have to get through this whole issue of buying at all-time highs. I had a tough time buying at all-time highs, but after I started, in few of the stocks which I bought at all-time highs, I think it's okay to buy all-time highs if the businesses are great. My first position in Mercado Libre was at $360, $350, $360, around that. Then I added another one. There's a story. I actually sold when it hit almost double, 580 or something like that, or 600. Then I realized, shouldn't have done that. This is a great business, because I sold it because I didn't study the business before it. But then I started studying about what Mercado Libre does. And then I said, okay, I need to get back into it. After that, I've been buying it. It's making all-time high. I've been leaning into positions. The recent one which I bought was when Mercado Libre was close to $1,500. Okay. It could still make another all-time high. So I have bought it from range of 350 to all the way to 1,500. And that has worked out well. Similar case with Amazon. Started initial position, it was $1,600. It was all-time high. I passed it over Amazon thinking $650 or too expensive. Eventually got around buying it at $1,600, $1,600 something. New all-time high. But then thought, no, it's a great business. Got to get in. Has worked out well. So I don't focus on all-time highs when if I would like a business, I want to initiate a position and it is good to start with. I'll start with even if it is all-time high. Any thoughts on copper? Yes, if the infrastructure bill and given the electrification of the cars, the demand on copper is expected to grow. So I am bullish on copper. The option is not liquid, slippage is too high. I think you're referring to Mercado Libre, because Mercado Libre options is not liquid. The slippage is big on Mercado Libre. And doing the spread on Mercado Libre is always a challenge. So, but I'm aware of those, and based on that, then I trade within my limits. But Steve, let me know if you were talking about something else. But I'm assuming because of all the stocks that I talked through, Mercado Libre is the least liquid from an options perspective. And I always have a tough time in trying to close out the spreads. All right, let's look at a couple of stories. Then we jump into buy now, pay later. Another one caught my wood. Investors buy Robinhood share after disastrous IPO. Yes, they sure would. And we saw that what happens to Robinhood this week. It became a meme stock. And I actually felt sad that, it has ended into the meme mania. That means most of the big investors, institutional investors, or the analysts who have been covering the stock probably will step back, because no logic applies when it becomes a meme stock. We don't know. There's nothing that I could say about this stock. It could go anywhere. So then why waste time on putting hours into this stock? It's a lottery ticket. So it was around $35 Tuesday, and then jumped up to $50. Another next day it jumped from 50 all the way to 85. This was the most mentioned stocks on Wall Street Bet. And while Hood was jumping, the GameStop and AMC came down. So money was rotating between the meme stocks itself. Again, everyone has a limited capital, especially those retail investors who are playing meme game. So they have to rotate from one to another. But who benefited the most by this rally? I don't think there were retail investors who benefited the most, because the moment it hit these high numbers, astronomically high price, 97 million shares from early investors were sold into this rally. Those investors include, the hedge funds, the VC firms that have provided liquidity to Robinhood during the February meme mania, when Robinhood had to stop trading and they had to immediately raise $3 billion. So that point of a time when they raised that $3 billion, they gave shares to these Andreessen Horowitz, I think Devon Capital. There are a few more. I forgot the names of those hedge funds. They awarded them shares at a discounted, shares were discounted at 30% of whatever the IPO price would be. So the cost basis for those investors, the IPO price was $38. So you discounted by 30% means say around $10. So $27 was their cost basis of all those big institutional investors. They took opportunity. A lot of retail investors willing to buy at these astronomically high prices. 97 million shares were sold by those insiders and early investors. And I guess some retail investor probably bought at those prices, 57, 60. So why did it go to 75? Because Robinhood, the option started trading on Hood. So the same game plan, buy out of money call options, try to effect a gamma squeeze on it. So if you look at it, let's go back to August. Look at the amount of the options call being bought, 12,000 contracts at $70 strike price. These were the numbers when Robinhood was trading at like $35. The same game that they try to play with. We have seen with GMCs and sorry, not GMCs, GameStop and AMC, GME and AMCs. Similar stuff here. But will they be able to get a short squeeze? I don't know, because I don't think Robinhood shares are that short. So what's the short float? Okay, we don't even have a numbers yet. But I don't think this is a heavily shorted stock. Yeah. So I was reading another stat wherein they're saying even though the number of contracts were more on the 70 call strike price, at one strike price, if you look at it, it's a 70 where the most contracts were trading. But if you look at the overall, there's a lot of a put buying that also happened. And so overall, there was more put buying than the 70 call contract. Again, this now has become a meme stock. It's sad because now no logic will apply on this one. So, but I think those early investors made their money. Jay says, I did well this week with Hood strangles 25 put 170 calls. Yeah, I won't sell any calls on this one because the craziness can go wherever, it could continue to stay very crazy. But sad to see this. And the last one before we get into BNPL is Facebook entry movie streaming business. Looks like a documentary movie. It's the first one. The documentary movie will premiere on Facebook at $3.99 on August 19th. Again, the whole idea is that this individual news is not that great, but the overall concept that Facebook could become a platform for smaller filmmakers and studios, not the big ones, but the smaller ones. That's certainly a good news. A different revenue stream for Facebook. All right, well, I'll skip some of the other ones. We'll jump into BNPL. Let's see a question. So these unusual way out of money contracts are ways to impact gamma even if it makes no money but loss in pennies. No, so the way gamma, so the what I if I'm buying an way out of money calls, because the reason why they buy way out of money calls because they're very cheaper. You buy those cheap out of money calls which will force the market makers to buy a stock because they have sold calls. So they are low in delta. They have to buy stock to become delta neutral. So they buy stock. And then if you buy a stock, what happens? There is a little more demand for a stock. So if there is no one who is selling the stocks, and if there's a big crowd which is continue to buy the call options, market makers will have to continue to buy stocks at higher and higher prices. And that means the stock prices continue to increase, that means the call that you bought is getting closer and closer to at the money. And as we talked about in option boot camp, the gamma starts to increase. The gamma is way higher near the at the money, and that's what is called terms of the gamma squeeze. That's where the word gamma comes into this picture. But that's essentially it is. And if the stock is heavily shorted, then the market makers have to pay more and more to buy these additional stocks to get to delta neutral. That is why it worked in GameStop and AMC's. I don't know if it will really work out in Robinhood, because there may be plenty of shares. 97 million shares came to the market in this last week. They are now available. So that is why when 97 million shares came in, the Robinhood stock fell down, because you cannot do the similar kind of a short squeeze and the gamma squeeze to market makers the way we were able to do it in GME, because it was heavily shorted. So I don't think that will work out. Let's get into buy now, pay later. Last topic. Try to understand this industry and see if we can put our investment thesis together. So what is this buy now, pay later? So as maybe we are already 11:56. This will at least take half an hour to 45 minutes. You know what? If you're okay, I would skip this. I'll do it the next week, because it'll take a lot of time to cover on this one. Maybe we'll go through some of the other topics that are skipped and go through the option trades. We didn't do that last week as well. But two things I want to do in a buy now, pay later is talk about this industry, and also we'll review the biggest news that happened recently is a Square spent $29 billion to get into this market. So that got me thinking, let's research this market. Square is spending almost 1/3, because that time Square was valued at $110 billion. Square was spending almost 25%, 1/4 of its market cap to get into this market. So that is why I wanted to dig deeper into this market. So I don't think we'll have enough time left. So I'll do it next week. Hope you're all okay with that. And let's cover some of the other stories and answer more questions. Go through the option trade reviews. You all good with that? I want to do justice with the BNPL. Don't want to kind of rush into it and leave many of these questions unanswered, because that's a new field. Buy now, pay later. We all know how to use credit cards, debit cards, pay in cash, but now you can buy it and pay later, and more money is moving into this. So we'll do justice to that, and we'll cover that next week. Meanwhile, a couple of other things let's look at, and then we'll jump on to option trade reviews. So if you're not into option, you want to skip that, feel free to drop. This caught my eye today morning was a big article on Wall Street Journal. If anyone is interested in it to get into the details, ping me or send me an email. I can download it as a PDF and share with you. But it was interesting to see that many big investors, individual investors, are now looking to say goodbye to 1% investment advisor fee. Reason is, again, based on who you hear, but let's say Morningstar and some of the other houses that predict where the market could be going. Their predictions is that US stocks will average 1.3% annual return over the next decade. So US stocks have enjoyed great growth in the past decade. But this party may not continue. The expectations is, again, this coming from Morningstar Investment Management, that the US stock will average just 1.3% annual return. So if your returns are only 1.3%, and if you're paying 1% as an advisory fee, that really hurts. So there's a whole big article on Wall Street Journal today around people are looking to say goodbye to 1% investment advisor fee. Again, this is the power of compounding. So the average investor with 750K paid 1.04% in 2020. That's on an average, those with a bigger portfolio have paid to someone to take care of their portfolio. The growing alternatives come as many experts are predicting lower market return after years of soaring stock and bond prices, we just talked about. When a portfolio is rising by double digits, as it has in the previous decade, 1% seems less significant, even though it takes a toll on the portfolio growth. But hey, I'm making 15% year over year. 1% taken by advisor. I know it is, it's holding back my growth, but it's okay. But in a low return environment, fee consume bigger portion of gains. So if stock rise only 1.3% as predicted, if you invest 10,000 a year, you will have $106,057 at the end of the decade. But if you pay 1% annual fee, you'll have only 101,361 left. So you're investing 10,000 per year. Overall, for 10 years, if you invested it, you have invested $100,000. And you're left with only 1,361 as gains, because the rest of it has been taken away by the fee. Even if you get better returns. So if you invest $10,000 a year for 35 years and you get 5%, still the difference between no fee and the fee is still higher. It's like $233,000. So net, the arithmetic of investment fee in a low return environment can be devastating to the nest egg. So people are looking towards options, towards the choices. I have to use the word options really carefully because we don't talk about the options as a trading instrument, but people are looking towards the choices wherein they can pay lesser fee and still be invested in the market, especially if this low return market is coming up. What about those with robo investment portfolio? How are their fee compared? So robo investment, they don't charge 1%. I think their fee are way less. And again, they have different tiers, but let's look at, I think long back I'd done comparison of robo investment. Let's find out robo advisors. And when Wealthfront or Betterment, they all started to challenge these advisor fee. All big advisory firms or the traditional investment advisor firms came up with their robo advisory services, right? Vanguard came with it, Fidelity came up with it, because they all were kind of threatened by the robo advisory companies. Just don't look at Vanguard charges 0.3. So 1/3 of the normal average fee charged by advisors. So hold on, there is two different ones. This is where I think you'll also have access to an advisor. This will be completely automatic. So which is like 0.15, 1/10 of the fee that is being generally charged by the advisors. Okay, best robo advisors: Betterment, Charles Schwab, LA Invest, SoFi Invest, Vanguard, Wealthfront. So these are the comparisons. I'm trying to see. This is what Betterment is 0.25% to 0.4%. Charles Schwab says none. LA Invest has gone to $9, depending on service level. SoFi says none. Vanguard has got 0.3% on asset less than 5 million, and it scales to 0.05%, 5 basis points on more than 25 million. Wealthfront says 0.25%. So still almost 1/4 of the general investment advisor fee. It doesn't hurt if we are making double-digit returns, but if we are only making 1.3% on an average for the next decade, there will be huge difference between 1% fee and a 0.25% fee. Yeah, so Asif shows 0.25% for Wealthfront account. Ramesh, Schwab makes money on the cash it requires in the account. Yeah, I mean, we have to dig deeper into it because most of them will keep some money in cash. Schwab may be holding more money in cash. That I don't know, but they'll find other ways to make money than to kind of a charging you. And now I think recently Wealthfront has also allowed. Was it Wealthfront Betterment? I think it is Wealthfront. You can invest in crypto. One of my friend who has Wealthfront account, he told that now you can actually pick individual stocks. I'm like, then it's like you become a regular brokerage account. You can pick up individual ETFs, and ARK Invest ETFs are now available for Wealthfront customers. So Asif, you can confirm. I don't have Wealthfront account, but that is what I heard from my friend. So yeah, if the market returns are tepid, we might see a lot of money flowing into these low-cost investment options, and moving away from the individual advisors. Yeah, so Asif, I just asked your help to confirm if on Wealthfront you can now buy, let's say, ARK Invest ETFs. That's what I heard, that now they've expanded the options. Not options. Now they've expanded the choices for their customers in terms of where they can invest in. Earlier, they only had a few ETFs. You can pick and choose, but now they've expanded the overall choices. And now you have some ETFs available, ARK Invest ETFs and whatnot. And I think there was an article that they'll also allow their customers to invest in crypto. That article I read. Okay, so we already talked about crypto recovery, not go through that again. This one was one interesting chart that I came across. It's a part of a book. So now I'm planning to actually buy this book. It talks about the overall euphoria over hyperscaling of tech companies. And this is related to SoftBank. And if you dig deeper into how SoftBank invest, if as a startup founder, I go to SoftBank and then say, I want $10 million. And this is my business plan. The way SoftBank used to work in the tech companies is, they'll say, take not 10 million, take 100 million. Go spend, but capture the whole market. Don't say that you want to have 40% of market. Go and get 80% of market. Spend money like crazy. So there was a whole euphoria of these tech companies getting into bigger and bigger scale, fueled by unbridled flow of money from VCs, especially SoftBank. We have seen the results. There are companies like, was it Pug or Paw? There's a dog, what do you call it? A dog walking company. SoftBank gave them what, 300 or 400 million dollars. Now they have to write off all their investment. So this chart is for their WeWork investment. Masayoshi Son has got to look at when he was presented by Adam Newman on how he wants to grow the company. And rather than getting into these details, their plan was by 2021, we'll get 10K locations. What Masayoshi Son is looking at is that WeWork could be a $10 trillion company by 2028. No, just take the money. Just grow the company like crazy. Really didn't work out for them. And this was a whole euphoria on hyperscaling of these companies. And not just SoftBank. When it comes to money, investment bankers will also sell their soul. The Goldman Sachs put together this chart. It says path to 1 trillion for WeWork. So isn't that amazing? Now that, and when it came to IPO, we all know what happened with WeWork. So a lot of backlash on the type of a business which they are in. In fact, WeWork is not even a tech company. Yeah. But this was an interesting chart. Based on this is how, if you have got $100 billion to spend in Vision Fund, the due diligence actually takes a back seat. We've got a lot of money to spend. Who cares if we lose $1 billion here, $2 billion there? We got $100 billion. Not only just WeWork. I've seen some of the other investments, international investments from SoftBank, also in the similar vein. Just give the founders money, sometimes double, sometimes 5 times what they are actually looking for, and asking them to just go grab the market share. So that is an interesting graphic. Jay asks, what's the book that the graphic is from? Let me just find out. I don't know if I have that tab still open. I think this was again a Wall Street Journal article where I saw this. It's a book that has been on a WeWork. Someone wrote a book on WeWork. I don't know if it is $1 billion. Oh, this one, The Cult of WeWork. Yes, in that article, I saw this graphic. That's why I remember. This Cult of WeWork, in which this graphic is there. Oh, there we go. It also. So, yeah, I want to buy this book. I'll probably buy this book and go through it. There could be a lot of investing lessons in, why we have to be careful when some of these companies that come to public market, the companies that have enjoyed gargantuan amount of valuation in a private market. Private market valuation could be anything. It depends on who your sponsor is. You got a rich VC dad who is willing to pour in so much of a money, your private valuation will go through the roof. But the public may take its own time. Look at what happened to Uber. Funded by SoftBank, rich valuation, came IPO at that rich valuation because investment bankers will also sell their soul and peddle those shares at a rich valuation to everyone. Uber hasn't even gone back to its IPO price, if I recall correctly. What's the Uber IPO price? Right now, Uber is what, 46, 47? 45. Oh, so they barely came back to their IPO price. Oh no, it's now it's 44. So not even at an IPO price just yet. So got to be careful between the private valuation and public valuation. So yeah, I would want to. I'll probably buy that book. So some of the tech companies are selling their real estate offices and leasing due to pandemic might help WeWork. Yes, so WeWork has seen some good growth because of this COVID. Because offices are closed. And again, as an individual, how long would you want to go, stuck in home? So there are some people who will go and maybe rent out a desk or rent out a conference room in a WeWork to take calls. I can't take that at home. Too much noise around my home. Maybe something else going on home. This is some construction going on home. People are working. See what's happening to Home Depot and all this. A lot of work happening on your home. You could go and rent out in a WeWork. So WeWork has seen those tailwinds because of COVID, but still nowhere close to the initial valuation which Goldman was trying to sell to us. Right? I think that's the excuse me. So that's the whole point. Private valuation versus public valuation. We have to do our own homework and just cannot rely on the projections given by investment bankers. All right, so we'll go through buy now, pay later next week. Let's look at some of the option trades. We didn't do it last week, so let's spend 5 minutes on this, then we'll be done for today. Unless there are questions, I can still hang around to answer some more questions. But not previous week, but previous to previous week when we last met, these were the 3 open trades that we had based on the trades that we. Oh, I missed this one. Yeah, so overall 4 trades open, 4 closed. This week as well as the previous week looks to be good. Because last week also we closed 4, all were profitable. This week also closed 4, all were profitable. Well, let's look at the trades that we have been discussing in this meeting. Last time when we met, we had these 3 trades that were still open. All of them are still open. So ARKK, we have a covered call on it. It is still open, $125 covered call. Stock is 123. I don't mind it getting called away. It's making some, overall, this ARKK investment has really worked out well because we initiated this, we got this 120 through a short put. So our cost basis was already less than 120. Then a couple of times we are selling this covered call. So further reducing our cost basis. So I think if I read our cost basis, maybe, hopefully, did I mention it here? What's our cost basis? It's below 113. So that's why I love to initiate a position selling put, then continue to sell call to reduce the cost basis. So even if it gets called away at 125, it's okay. We made 12%. So I'll wait. If it gets called away, it's fine. EEM is an emerging market. Open this trade, a bullish trade for diversification perspective. It was being challenged earlier, came back up. Right now, it's no profit, no loss. But even if I get assigned on this one, I will probably take that assignment because it gives us exposure to emerging markets, so markets outside of US, China, India, Russia, Brazil. So I want to have that mix in my portfolio. So we'll wait and watch. If it stays above 52 and hit the profit target of 50 to 60%, I'll close it. Right now, it is where It's no profit, no loss right now. But if it stays here or higher and the premium decays, I'll close it, open a new one for September expiration, because I want to have exposure to emerging markets in my portfolio. Third one is Skyworks. Opened it on 30th. Slightly bullish in this chip supplier to take advantage of elevated IV after the earning result. So have some shares in long SWKS. Oh, this is making some decent amount of money. We opened it on 30th of September when the Skyworks was 183. So 30th, 183. After earnings, it fell down. Again, we got to focus on business, not really on what the share prices happen right now. Looked at it, looked at what Skyworks does. Is it an overreaction? May not be. I was a little bullish, so I opened up a bullish iron condor. It wasn't a neutral one. And so far, it is kind of looking okay. So it's a $10 white iron condor. And we collected $384. The premium means the maximum loss or the risk is $620, close to $620. Then opportunity to make 380, which is a risk reward that I like. And we were able to get this huge premium because the IV was still elevated. That's the reason why we did this trade. Yeah, looks ripe to be closing. So I think I already have a closing order on it. Hopefully, if it hit, it's right now, it's in the middle, so I don't have to worry about it. Let it decay a little more. Hits 50%, 60%, we'll close it. Should turn out to be good. So far, it looks good. Stock hasn't moved much. Stock is like from 180 to 186. But the IV has decayed a lot. That has helped this trade, not the stock movement. So out of these three, none of them were closed this week. So we don't have zero. Other additional trade I want to bring here for discussion is XPEV. Again, we continue to sell a covered call in XPEV. So this was the same story. We sold a put on XPEV, got assigned, sold covered call twice. But this is, I think, the third covered call. Again, the stock is at 41, sold a covered call at 50, which means 25% from where the stock is currently trading at. But it's called away at 50. That's fine. We made enough money on this one, including the premium, etc. Our cost basis is less than 35 on it. So less than 35 cost basis, getting it called away at 50 is a decent return on investment for 42 days. We'll hold it and see where XPEV goes. So that's for the new trade wanted to share for this meeting. Till now, we talked about 52 trades and 48 have been fully closed. These 4 are open. We'll see how these perform. I lost money on 9 of them, 39 have been profitable. So we'll see which one of those add to the profitable tally or the losing tally. We'll see. That's on the option trades. And end of today's session. Let's I can hang around for 5-10 minutes and talk, look at any questions. All right, I see a comment from Wasif. Uber should buy Upwork, just 5% of their market cap. I think Uber has to focus on getting to adjusted EBITDA profitability. They have been left behind in this particular race by Lyft. So this week, this previous week, both Lyft and Uber, they announced their results. Lyft surprised the market by getting adjusted EBITDA profitability a quarter earlier than what they were expecting. Earlier, Lyft had told that they'll get to this milestone by Q3 of 2021. But they already achieved it in Q2 of 2021. Uber, still far away. They haven't been able to get to adjusted EBITDA profitability yet. Now, take this adjusted EBITDA profitability, with a pinch of salt, because you can, adjust whatever you want to, but market is okay with it. So that's one race in which Uber has to really do well. But I understand why Uber has not been able to get the profitability, because they have to continually invest to grow their Uber Eats business to compete with DoorDash and Grubhubs and maybe now Instacart, and who everyone is getting into food delivery business. So they have to continuously invest. That is why they are not able to focus on profitability. But I'm okay with that. So whether they'll buy Upwork, I don't think so. I think that probably comment was just on the lighter side. But I don't see Uber buying that. Does anyone use social sentiment indicator in POTS? It looks at positive and negative mentions in social media. I'm the one who probably will not look at that. Okay, so there's a link. Equities tab. So where it actually is, it says, okay, let me just open up. See, there is always new things to learn. I says chart settings, go to equities tab. Okay, let's look at there. Go to charts. Let's go to the chart settings. Where's my, okay, this is chart settings. Go to equities tab. Where is social sentiment? Activate show social sentiment. Where it is? Show options, show CNBC video. Oh, there it is. Okay. What does it do? Oops, did anything change over here? Available in hourly and daily charts. Oh, come on. Nah. I have no idea. I mean, even if I can figure this out, how to make this work, I will probably not use social sentiment. I generally don't like to follow the crowd. I'll make my own decision. Okay. Oh, it says only on some stocks, not all. Okay. No, clear shows I have no idea. How does this work? So I have not used it. I don't know if anyone else have used it. If you want to share your feedback, feel free. I see another question. Zifty asks, for covered call, usually what delta you aim for? Depending on what's my thesis behind doing that covered call is. If my thesis on that covered call or the covered call spread is just to make some yield to reduce the cost basis, then I will do it 16 delta or less. Sometimes I've gone to 10 delta and sold a call over there or a call spread over there. But if my intent is to, it's okay. I don't like that share, this share too much, but I don't hate it to sell it right away. But it's get called away. It's okay. I won't feel the pain. In that case, I will sell a covered call closer to 30 delta or 35 delta. If I really hate the stock and say I don't want to have any positions in this, then I will sell at the money covered call for the nearest expiration period. So depending on what's my love or hate relationship with the stock, I'll sell cover call accordingly. Yeah. So hope that helps. There is no one clear-cut answer, because I have done, all these types. Uber invests a lot on AI, which is not making money but losing money, but they aim for future edge. Yeah, possible. I think Uber is investing. They have to get through this whole. They'll make money if they can get through this whole autonomous driving. Otherwise, this whole food delivery business and the ride-hailing business will be difficult to make money on, as long as they have to continuously pay, drivers. And for this, particularly this quarter, they had to pay more compensation to drivers so that there are drivers available to come and drive for Uber. So they still lost, I think, $500 million for this quarter, which is not big if you talk about Uber. They have lost $1 billion and couple of, multiple of $1 billion in a quarter. In previous years, before this new CEO, Dara Khosrowshahi, became the CEO. And only after he became the CEO, he started removing a lot of a flap from Uber, sold off their autonomous vehicle unit to, I guess, Aurora Inventions, sold off their, I think there was some air travel or heli services, sold off that, focusing only on ride hailing and food delivery. So I like that. So we'll continue to stay in Uber. And again, keep reducing cost basis. Cool. All right, any more questions? No, we are okay. Then looks like we're done for today. Next week, we will start with BNPL, review that industry. There are secular changes happening in society, which has given birth to this BNPL industry. So it'll be interesting to go through that in our next meeting. All right, then. No further questions. Thank you, everyone. And we'll talk again next week. If you're attending crypto, we'll get to talk to you in Thursday meeting. If not, we'll be here next Saturday then. Goodbye, everyone. Have a wonderful weekend and profitable next week.